and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, with rising inflation, fixed income funds struggle, and they're likely to do so in an interest rate hike scenario. Rising interest rates are also likely to hit equities, so not a very conducive time to retire. Or is it? Well, don't you worry. Watch today's episode, because today we'll tell you how to earn inflation-adjusted regular income post-retirement and enjoy your golden years without having to worry about money. Stay tuned.
Falling rupee, falling market, rising inflation, and the war continues. And there are talks of global recession. This requires careful planning for anybody retiring now. If you are retiring now, you will have to list all the things that you should be doing, essentially doing. You can't really let it go, let it happen the way it has been happening so far. You have to worry about multiple things and very carefully. And I think, you should be very much on top of all these things. Take your pad out, list all the things that you have and all the things that you need, and plan things in a manner that you don't run the risk of outliving your savings. That is going to be the worst situation you want to be in. Your investment plan in retirement should be entirely dependent on your financial status. If you are going to depend on income from your investment to sustain yourselves, then you need to worry about it. If you have some income stream, whether by way of pension or by way of some alternative income stream, you are getting some rental income or whatever, then you have to, then all your investment could well be long term. You need to tweak it a little bit, but you don't need to do anything substantially about your investment. So this is the first thing. First, determine what is the scale of dependence on for income on your investments. You have to worry about 2-3 things: your health situation, your lifestyle requirements. Some of your expenses will go down, some of your expenses will go up, and some new expenses will crop up. You have not been going to your children abroad, and now you think that you should be going every year, or some such thing, which you have been waiting to after a lifetime of work. You have been postponing and aspire to do those things. So some of those aspirational things, it may not look like a necessity, but it may be very important to you. So plan those things, and that is something which your investment plan should be able to support. There are people, who all their life has been conservative. They have saved and invested conservatively, and all their accumulation, and they never got time. They were busy with their work, and suddenly they are faced with, all their accumulation. They have not been used to it, having it handy at one place. So assuming that, you were working hard and you are saving, and, you started with 5,000 rupee, 10,000 rupee, your provident fund accumulation, then you got your gratuity, and all of it adds up to something like 1.5 crore. And 1.5 crore might look very substantial given the kind of income you were used to. But look at it very carefully. This 1.5 crore may be enough, may not be enough, or may be substantially less, or maybe much more than enough. It entirely depends on what you aspire to do. This should generate income. It should also grow besides generating income. And all the money should not be consumed in your lifetime. So these are things which you should keep in mind for your investments in retirement. Besides this, you should generally be following for all your investments the basic foundational thing. You should have your emergency fund. What you need in the next 1 or 2 years should be handy. And then rest of the money which you are not likely to need to be able to beat inflation should be in equity, or should be in little venture sum, or it should be calibrated investment so that it is able to beat inflation. The most important thing any retiree should worry about is do an evaluation of all the healthcare plans that are available. Health insurance is critical because most Indians are just, one illness away from poverty. Go shopping for your health insurance carefully, where there'll be, and it requires careful selection, and look at it as a protection. If you are doing fine, it might not look necessary, but it'll create a great panic if it is not planned for. So look at it as an essential expense to make sure, because it's just not health insurance. It is ensuring your financial security. Then comes, careful planning, that how much money you require. You will have to do some careful arithmetic in terms of how much money you need for your essential spending. Then you will have to do some careful, estimation of the supplementary income for any other desires or needs or, plans or, all the, postponed aspirations that you may have, and do a balancing. Can you do it easily? Go ahead and do it. If you can't do it, then do some kind of balancing in terms of where to settle, or maybe something can be postponed depending on how your investments do over a period of time. Action plan is broadly two kind. If you have no income requirement from your investments, somehow you are very fortunate to have pension flowing into you every month, or a rental income coming to you every month, and your needs are, so you are still an investor even in your retirement. If you have regular income requirement in your retirement, then you need to plan for it, and the planning should be very straightforward. I would eliminate all the formulas and any complex jargon out of it. Whatever money you need month after month for the next 2 years, just total it up, put it in a ultra short term bond fund or liquid fund, and then comes planning your investments for the remaining money. So assuming that your requirement is something like 25,000 rupees a month, and you have 50 lakh rupees worth of accumulation from all sources. To begin with, you need to put 6 lakh rupees in ultra short term bond fund and put your systematic withdrawal plan in that for 25,000 rupees. This is your fixed income taken care of for the next 2 years. Now you need an investment plan for 44 lakh rupees, and which should be generating much more than 6%, simply because 6% is your consumption requirement, that is your withdrawal rate, and maybe more because 3 years from now or 2 years from now, you need more money because of inflation. So that is something that will be achieved only by investing in equity as well. How much equity? For sake of simplicity, in this illustration, think of investing something like half of it or maybe 60% of it in equity. If this is your requirement, if say 6% and more, 6% is your consumption requirement, and the capital has to grow to beat inflation, which means that at least 22 lakh rupees or 25 lakh rupees has to go into equity. That should be spread over the next 2 years. If you invest your 25 lakh rupees of the remaining 44 lakh rupees in equity and the market goes down by 10%, it will be heartbreaking. It will create a financial crisis and great deal of anxiety. It will scare you. Remaining money you should invest in fixed income. Now, in retirement, the fixed income ladder is pretty straightforward. First and foremost, go for the senior citizen savings scheme. It is the highest yielding, safest, government-sponsored plan. And there, the maximum investment that you can make is 15 lakh rupees. Then comes Pradhan Mantri Vay Vandana Yojana. There, the maximum investment could be 10 lakh rupees. So this takes care of the next half. Assuming for investors who need little more, who can invest little more, then comes the post office MIP. So these are, I think, the essential foundational fixed income investment for all retirees to generate income. Why I'm referring to these? Because they are the safest in the country. Not only that, they are also the highest yielding. Of course, they are taxable, but depends. If it is the only investment which will be generating income, you will be well below the taxable bracket. And then subsequently, if you have more fixed income investments to be made, then you will have to look for the short-term income funds and other things, and then come to value research, look for the best funds which our analysts are recommending. Our analysts also will tell you the best funds which are worth investing, and when they will not be worth investing, when they actually decline in their performance decline, or there is something to worry about them, because these investments require monitoring. Not necessarily very intense monitoring, but you will have to keep an eye on that. So this is the ladder of investment. And when it comes to equity investment, the one which I was referring to, where you should be doing your 2 lakh rupees SIP over the next 24 months, that should be a diversified equity fund. That should be one of the larger mid-cap fund, or a multi-cap fund, or a flexi-cap fund. Don't get into any of the narrower categories. The narrower categories are only meant for people who are going to make a substantial part of their long-term investment, and they are not going to depend on that for their income.
Well, with that, it's a wrap. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. And thanks for watching. Bye for now.